In this training video for myself, I want to look at using the ask bid volume difference bars. It's a tool I haven't really used much in the past, just because I found it to have far too much information. But what I've come to realize now is the value of the ask bid volume difference bar is not in reading every single one of the bars, uh, because that can be confusing. It can be too much information, um, and oftentimes it just has no meaning. It has no relevance. Um, just like similarly, sometimes you're looking at some of the individual candlestick bars, they don't have any significance or meaning, and you wait for another one to give you uh, some kind of meaning. But instead of looking at every single bar, what I want to do now is, because I've added to or I'm creating my trading plan, and at the base of my trading plan, um, for now, what I want to do is look at trading activity or potential trading activity at the previous day's high, the previous day's low, and the current day's open, which is also the previous day's close. So I'm going to use the previous day's high, low, and current day's open as reference points, um, to then, when price gets to those reference points, I'm then going to look at the ask bid volume difference bars and see if any insights can be gained there. Now, the potential insight in the ask bid volume difference bar is, well, first of all, what does it show? The individual bar, what it shows is it's constructed in a way that there's a zero line, and on that zero line, above it is showing that buyers were greater than sellers, and below it shows that sellers were greater than buyers. And I'm not going to get into um, hitting the bid and hitting the ask, and limit orders and market orders and things like that. I'm just going to leave it as simple as ask the when the bar is green on my chart here and it's above the zero line, it suggests in that corresponding time period, for the candlestick above here, there was more buying than selling, and when the bar is red, there is more selling than buying in that bar. And then the things that I would want to look for, um, I know the obvious is divergence, and that's not really what I want to really be looking at. It is a valuable thing to look for divergence, yes, but at these reference points, I want to see in that at that reference point. So if I'm coming up to yesterday's high, which um, should be resistance, or can be resistance, when price gets there to yesterday's high, how what does the ask bid volume bar show, and maybe the bar before it and the bar after it, because that's when you use it like that, I think that's when the value um, will be present. And so when I come up to a reference point, is this showing me more buyers or sellers? And if, for example, it shows there's more sellers at a reference resistance point, then the bars after that, I'd want to see continuation, not only in the candlestick bar of price up here, but I would also want to see follow through in the ask bid volume difference bars, because that would show the strength of the buyers at that level. Now, I also the only it doesn't always have to be at the previous day's highs and lows. I could also use it at the the current day's open, which is the previous day's close. And then if we don't quite make it up to those either the previous day's high or low, or I see something happening on the chart, I could I could use it at, say for example, I had a trend line break. I want to see what is that what is the as bid volume difference bar showing at that trend line break? Is this one of those trend line breaks where it just has a look up, goes on the other side, or maybe the trend line break is not the trend line in itself is not reliable, um, and so in those scenarios, that's where I want to use this tool. That's just the changeover on the hourly bar there and the 30-minute bar. Um, so right now, um, so what I'll do is I'll read this, use this tool um, on the most recent 4 days, which is what we have right here, and I'll start with um, this day here because it has a nice, neat, and clean example. Um, Actually, no, I'll start over here on Friday's uh, behavior because it's not as neat and clean as this one is. I mean, this one here, you simply have the high here from Monday's trading, and then on Tuesday we come up to the high. It holds fantastic as resistance, and then you see a nice drop, which was about 77 pips. So that's a nice smooth one, and that one worked out. But I'm not sure how long I want to make this video, but let me use this one here because here's one of those where I was saying, just if we don't make it up to the previous, in this case we didn't make it up to the previous day's high, we didn't make it up to the previous day's open. Instead, the reading should is coming off of activity off of the um, the open of the day, and also this trend line here. So we had this, just looking at candlestick formation, we had this slow move up, which is looks corrective because we had this impulse move down, one time frame all the way down, and then we have this trend line break here. And so what I'd want to do then is study the uh, the behavior of the ask bid volume difference bar around here. So I'm looking from, let me put in some vertical lines. In particular, I'm looking from this this bar to that bar. What did I do? Um, Really, it's in here. That's what I want to look at, which is going from here to here. So what happened? So we see this clean break um, of the the highs up until 3 o'clock in the morning, and the 3 o'clock hour is typically a very reliable hour. When you see a clean break like this, then the thought process is perhaps we're going to get a deeper retrace. This is a nice big move up when you look at the candlestick, and perhaps we're looking at a bigger retrace, and we're probably looking at maybe going to test yesterday's open, um, which is would also be the London 3 a.m. Low as well. So that's very realistic. And so what I'd want to do then is look at the 3 o'clock bar uh, as bid volume difference bar. And the 3 o'clock as bid volume difference bar is this one right here. And then what do I see? I see a clean, I see a nice, strong as bid volume difference bar. There was more buyers than sellers inside of um, this inside of this bar. And so what I would want to see is that very next bar to continue with price up And just looking at the candlestick, that looks like a bullish bar. It doesn't quite make it down to the highs of this 2 o'clock bar, and it's about halfway of the body of so that looks pretty good. But then I looked, so and again we want to use reference points. So that's the 3 a.m. is a good reference point. A break like this where we break above the early day high, then we look down here and we see we want to see that next bar continue. We were feeling good that this looks like price, but then when you look at the ask bid volume difference bar here, it's actually showing there was more selling than buying. And so now I have to now if I'm in a long trade or if I'm thinking of opening up a long trade, I have to be very careful. And then I would start to say, well, what tools can I use? Well, one tool I can use is I see these higher lows and I can start to connect them and draw a trend line. So that's one trend line that way. I could draw a second trend line this way. I then also have another significant reference point, which is the daily open. And then I say, okay, well, how does it behave at the daily? If price got to the daily open, how does it behave there? Does it hold and then move price up? And so that would suggest buyers should come in based on showing on the 3 o'clock bar, the buyers are coming in. Um, and then if anyone was long in here, where would their stops be? Well, the obvious place for stops would be below the previous day's low, below the intraday low, or below the 3 a.m. Bar, which gave us the up. So if they were long from in here and they were feeling good, they could potentially move their stop up to that level. So then we'd say, well, we'd want to see if their stops hold and if they get stopped out, um, and how price behaves. So we see that the bar immediately after this up move has a down um, as bid volume difference, and then that alerts us that perhaps we might want to really, if we were to take a long trade, be really uh, sharp with where our stop would be. And then as we see price coming into that area, we might think, well, it shouldn't be coming into the area that I want the stop to be. Maybe I might want to hold off on taking that long right away. And that's because this should not have happened. If this bar was going to continue, if price was going to continue its way up, and the way this bar finished up nice and high like that, then it should not then follow with the down bar like that. And then with the next bar, we're thinking, okay, we want to pull back to get in long. We shouldn't see price retrace as deeply as it did, and we shouldn't. We should see the open hold when it breaks above like that. And then, and if the open doesn't hold, we should see the low of the day hold, or we should see yesterday hold. And it didn't do all of that. It just came even further down. And when it does that, now we want to look at the corresponding um, as bid volume difference bar there. And we can see we're still to the downside. In fact, we put a lower low in. And so now we have to be quick and diligent and change our approach. Nazar, you have to now. This is what real time trading is. Change your approach from seeing this uptrend that was in place get wiped out and no longer valid, and now start to look for short trades. And what you want to do is you say, well, we broke the day's low. We doesn't look like there's any kind of support off of yesterday's low, because look how deep below we came on it. And then when we open on the 6 o'clock bar, we don't go we don't go up at all. Um, and so when you see this here, and then what do you look for? You're looking for follow through, and we see follow through in price, and then we don't see follow through on this bar, but then this bar here is one. Um, it shows that there was more buying, but the price is still to the downside. And we have this reference. We've broken these trend lines, which is they're not big trend lines. They're short term, but we're now below the daily open and we're down below yesterday's low. And we're also coming off sorry, a rundown here. So potentially, uh, this this bar here that showed this, that could have just been short covering, or taking a little bit of profit, because this guy's here, if they had traded short from here, they were looking at over a 100 pip gain. So that's all that could have just been, because if that was really uh, new buying coming in, then this would have closed closer to the open. You would have seen at least peak above the open of that bar, and this suggests that we go. And then so then um, you continue trading, and then you don't worry about the as bid volume difference bar for the rest of the day. Um, because really there was no significant reference point that I could look at for the most immediate time frame. Maybe I'd have to go higher time frame, and if I am gonna take a long trade anywhere in here, I need to be patient with it and know that there has to be a rotation before we move up, and that's exactly what happened in here. There was some balance, and there was rotation, and then we moved up. Um, so then now we come into the new day, and what do I do? I start all over with this process. I'm going to erase everything, and I start all over in the process, and I say, well, I've got yesterday's open up here. I've got today's open here, and I want to see how I behave on that. I also have yesterday's low here. So if my thought process first would be similarly like it was up here, I would want to look at price coming up to the open from the previous day and the high from the previous day. And when that doesn't happen, we look for other uh, um, ways to find a reference point. And this is exactly what happened on Monday. I was hoping for price to come down here, and then that would be a good area to take a long trade. Um, but it didn't do that. So then, like I did on the Friday, I now have to rely on short-term trend lines, which is one right there, and I have to use the um, the days open. And so we open a day and we trade below the open. We move sideways. We're not getting much traction, and then we come up and we break this trend line and we move up above the day's open. So now I've got a reference point. I've got a signal. And what do I do then? I then take that signal, and then I look at um, what's happening on the as bid volume difference. So on this bar right here, we break this short-term trend line to the upside. We also get above the daily open, and now our thought process is that price might move all the way up to the previous well, that would be Thursday's low, but the previous day's open, or somewhere in between there. Um, or it could move further down to the lows from Friday. And so what I want to know, for it to move up, it would have to be buying coming in to move it up, and for it to move down, it'd have to be selling. So then I look at the bar that broke above here, that broke this trend line, that broke the day's open, um, and then see how it behaves. Now, before I get into that, what could have happened here on this bar here, which is the 2 o'clock bar, is we could have went up to this open, had a peak above it, and then come back and say perhaps close down like that, and somewhere down here. Um, and then what at that point the thought process would change, and the thought process would be, okay, I'd want to see what the as-bid volume difference bar looks like, and I'd want it to show that there was stronger selling than buying, and I'd want to see follow through. But that didn't happen. Instead, what did happen is it because at this point here we don't know if it's going to go up or it's going to go down, but we can use the tools. So here on this bar here, we see that we the reference where we break the trend line and we have more buying than selling, and in fact all throughout the start of the day we have had more buying than selling, and I know that we don't use every single one of them, but in this case we could rely on that a little bit, um, lightly. And then what you really want to look for is to see follow through and continuation. Now, before I even get back into the as-bid volume bars, here's a thing I like to look at, and that's the daily open. And this daily open, we break above it, and then it starts to serve as support. So you can see the next bar, we come down to it and we find support. Buyers come in, they move price up. The next bar, we come down to it. Buyers come in, they move price up. It closes down, but it closes above the open of the 3 o'clock bar, and we're seeing rejection or support off of the daily open, and we do that for the next 2 hours as well. So just as a thing here, oh yeah, here's what I was. This is this type of behavior here where we break above the open and then the open holds as support. That's what we didn't see here. And so similarly, if we didn't see this here, price would have come down uh, to the previous day's low. But we did see um, buyers stepping in there, and it's being confirmed. Uh, let's see here. We're looking at this bar to that bar, and it's being confirmed here in that you could see there's uh, more buying than selling. Now this bar here, it can, and this is nuances. You have to have nuances. This is where experience comes from. This is what the importance of experience. This bar is down, right? But we are closing above the open, and the open is holding us as support. And I think we saw this here, right? We close up. This bar is down, but we're closing above it. And then the next bar is comes and closed down, so price catches up to the as bid volume difference bar here. Um, and here's the one I think I was trying to remember. I was remembering here is that this bar was up, the as bid volume difference bar was up, but price was closing down. And why? Because we were below the days open, just like we were, just like we did here. We were above the open, so we have um, a divergence, but you have to use the other things available to you, and you got to say until we're not going to go down to these lows until we get below the days open. Because usually, typically, I can't say this enough to myself. The days open is can be used um, very strategically, and a lot of insights can be gained from it. So then we get the takeoff here, and we start to follow price. Now we don't really need to. We could just watch the bid volume difference bar to guide us, but we're really watching our levels here. We're watching the open, we're watching this trend line, and we're targeting the most realistic place that sellers would be sitting at would be up here, because this is where they started this is where this drop started from up here. So they'll be like, okay, if we get there again, we'll like it and we'll go short. So then when we come up to the previous day's open, which is up here, we now I want to start my thing all over, my process all over again. I want to look at the as bid volume difference bar at this reference point. And what happens at this reference point? At this reference point, we see price reject off of the previous day's open, and it closes below it, but the bar is still up. We're still it closes up. We're still one time framing, and we see that the as bid volume difference bar is also showing the same thing, that buying is still greater than um, than selling. And if this was, if price had got up here and everyone was just abandoning their long trades, then there would have been a lot more selling, and we would have seen this come down a little bit more. But they actually, as it plays out, it turns out that they that was done in here. The liquidation of these longs was done throughout in here. So now coming into the new day, we started over again. So we had this reference points, and it didn't show us that there was a significant selling coming in. Plus, we were one time framing. We never want to argue with one time framing until you get a strong signal. And coming into 12 o'clock here, typically after 2 o'clock, there isn't a lot much happening. And usually not good trades available then. So now my thought process is, I've got um, this high here. I've got this reference point here on the as bid, and now I also have, because it's a new day, I have a new reference point, which is the previous day's high. So the previous day's high is right here, and there's a gap between the previous day's high and which is um, Monday, and then Friday's high, which is up here. And so we could potentially run up here, or we could run up here and stop like it did. So what we want to do is when it gets up to the first available reference point is look at the ask bid volume difference bar, and that happens to be this bar right here. And what we would expect to happen at a resistance level at the previous day's high is to find resistance, to find sellers willing to step in, and that's what this bar shows. Now the sellers didn't step in um, strong enough to make the bar red, but it showed that when price got up there, they were active and they were strong enough to push it back down near to zero and leaving a bearish bar on the ask bid volume difference bar. And that can be relevant because it's also aligned with the previous day's high. However, the bar still closes up, and so now I have to be on the alert. And I say, okay, because of this reference point high here, because of this slight appearance of rejection, the bar still closes up, and that's still pretty strong. It's still an up bar. Um, I now need to be uh, careful with adding to long trades or taking long trades, and I'd want my long trade to be as I'd say if I was in a long, where would my stop be? And then I'd want my long to be as close to that stop as possible. So then I start to monitor. I could put in a trend line here like that. I become aware of where my daily open is, and because I'm this far from it, if I get to it, I should expect it to put up a resistance and move price back up, like it did over here. And if it doesn't put up a resistance, then chances are it's gonna go below it and then further down. And so what I want to then do now is now I've got my reference point uh, on the on the price chart that was hit. I can then start to put in tools to show me that there's going to be continuation or violation of the continuation, and which will mean that it is not as strong as it may look. And then I also want to monitor for follow through of selling activity or buying activity in the ask bid volume difference bar. And then I can see here on this 4 o'clock bar, it looked bearish. It came back almost to zero, and then there's follow through in the selling in the next 5 ask bid volume difference bar, which is represented on the price uh, candlesticks as well. And again, what happened? My reference that I could draw in, which is my trend line, that gets violated, it gets broken, and then it serves as resistance on the opposite side. We come down to the daily open, we go below the daily open. If this daily open was going to serve as support, like it did over here, then price would have saw buying coming in and move it up. And we don't. The first reference into the uh, open is this bar here, and we can see there was no buying in there. And the previous 4 or 5 bars prior to that was also showing there was more selling than buying. And so when you see that, Nazar, you have to start to say, um, this level up here held, and now it wants to go down, and chances are where's it going to go to? Well, it's going to come to the next significant reference point, which is the previous day's open or the previous day's low. And where does it come to? It comes right to the previous day's open. And again, now that we have this, you have to find a way to get in here. I know this is easy to say, to get in here and take the short trade, but ideally the entries here. And this is why it's important for me to be at the computer 3, 4, 5 o'clock in the morning, my time, to to take advantage of this better entry here. But if I was brave enough and I could take a short here and then target down, and they got there pretty sharp, 1 hour drop right to yesterday's open, the previous day's open, and there. And so when we get there, we would expect to find buying right here, right? And if we didn't find buying there, we'd expect to find buying on the previous day's uh, low. And so we look for clues now. Was there buying when we got there? Well, obviously this is the strong bar down, so that's going to have more selling. So that bar is really not the bar we would expect to see buying. Um, and 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 as well now, once you get a move like that, that is the 9 a.m. hour. You're not very rarely will price do a V pattern and move all the way wrong thing move all the way back up like that um, to that level or even higher up to where it came from. So what the thought process is now, this is just one tool I'm showing here. I also use the daily VWAP and the value areas there. And we're not going to move up until we get accepted into the value area. And you want to see how price behaves off the value area low, which is a different topic altogether. I won't get into that here. But you have all of these tools and you bring it all in together. And I start with my naked charts like this, where all I have is the previous day's highs, lows, and the daily open, and just candlesticks, and just read from there, and then see what's happening, use some common sense, and then apply all the other tools um, together. So um, that's we uh, we see that we come down here and we see strong selling, but the thing is, which is good. So it's telling you this move is pretty strong and it might have more to go. And just to skip ahead, we can see that right now we are back at that level, and this was just a corrective move back up. Um, and look at when it happened. It happened mostly overnight and late into the trading day yesterday. And so when you see a move down to the low and it's pretty strong like this, it could run away all the way down here, yes, and you're hoping that your runners from up here are still in place and you get that. But it is very, very hard, Nazar, and you shouldn't. It doesn't matter, even if it did drop away instantly. You should not be selling on the lows. Uh, if you miss it and it runs all the way down, you miss it, and that's fine. Um, you wait for the pullback. You wait to price to get to key reference areas, and that's where um, you would want to say, look, there was strong selling down here on this low. I don't think this is going to hold. So I want to wait for a pullback to a certain point. And then that's what you do then is you start to say, well, where would be my reference point? Where would be a good idea, a good place to take a short trade? And then that's when you start the process all over again. Now, I could have, again, put in a trend line here. And so, um, well, that this trend line, when price was here, I wouldn't know that this level here, but I would use my just some simple support and resistance. We break this, expect the price to come back up to this area like this. Typically, when you break a stop area like this, it rarely comes back and lets those guys out that was longing above here. Um, that would be one that I can manually put in and use my nuance ideas on, or the hard reference, which was the days open. Does it get back to the days open? And so when what do I do? I look at the um, the behavior of the ask bid volume difference bar at this level, and that's showing there's more buying in there. So then I might think that, hey, this this move for today might be over, but the move for the next couple of days might not be over. So then you could do um, late day trading, which is trading off of, you could say, well, you know what, the high is, chances are we're not going to take out the high, and it looks like based on what's happened at this level that the day's low might be put in, and then you could take a trade. Um, uh, you could take a trade because this is showing buying here. This could take a trade here to back to the upside with stops below here, or you could have just at this point, I don't think the as bid volume, like the intraday reference points, um, may not be the most uh, useful when using the ad bid as bid volume difference bar. What is more useful from what I found is having your reference points and then being able to draw in like trend lines and like that, and then use it accordingly. And these ones work out. It doesn't work out every single time. So I mean, if I look at what happened today, I know this video is 35 minutes, um, but if I look at what happened today, um, we come up to yesterday's open and we found resistance. So now we could have our first thought process would have been that the would be the open. We want to see how price behaves on the open. It's another 30 minutes that's just gone by. This video is going on very long. We want to see how price behaves on the open. Then we want to see how price behaves on yesterday's open. And then we want to look for price behavior at yesterday's high. And so we get on the open, and then you can see that here at 1 o'clock in the morning, we come back and we test the open. We go below it, and the following bar, we come back and close above it and put in a higher high. It's an engulfing bar. Um, I know it's only a 1 hour bar, but it is engulfing the previous bar. And then we move up. And so we could look at our reference point here, and we could see that at the open it was mostly selling. Um, However, price was not ready to I mean, if we price was not ready to move further down, because if you because you can see we're all of these except for one bar here, which is the 1 o'clock hour, we're closing above, and so we got to think that if we're taking short trades, then either stops would be above yesterday's open, or stops would be above this interim high here. And then when we get up to, and I typically won't be trading at this time, but 4 or 5 o'clock I should be trading. So when I come up to this, the first run up to the um, yesterday's open, we actually see buying, and we see buying from the previous bar. So then we got to, and it closes up. So then we have to wait for a further signal to say this is going to hold as resistance. Then the next bar, it goes further up higher. It comes back close below the high of the 4 o'clock bar, and closes above the yesterday's open, but um, on that bar, we can see now that, let me just delete that. We could see on that bar there was selling on here, um, and so now we see the selling, and now we could start to draw in our trend lines and watch for trend line violation, and watch for behavior off of the wrong one. We'll leave it at that, and then watch for behavior off for the open. So we see this here, and if this was going to keep it going its way up, you might see an it's not unheard of to see an oscillation or move back to the downside, and then watch for the open to hold. And it had an appearance that the open was going to hold here at 8 o'clock, because the open found some buyers because we moved price back up. We closed up for the bar, but then when we look at the as bid volume difference bar, we see that um, that showed more buying than selling, and so here was an example of um, the as bid volume difference bar really not helping us out. But what you have to do is say, well, okay, so this is great. Uh, this is where common sense and nuance trading comes in. This this bar here, which is this bar right here, which is the 5 a.m. bar, went up higher and um, went up higher and put in a new high, closes above yesterday's open, but the um, 5 a.m. bar as bid was down. So it's telling us that sellers came in here, and we know this not only because of that, but because the bars after that moved us all the way down into uh, the open for the day. And then when we get to the open, it shows a lot of buying coming in here. And so we have this conflicting signal. So we can now believe that this could, because of this bar was further up. I know there was selling in there. Um, you have to be aware of there was strong selling in here and strong buying in here. And if the buying at the 8 o'clock hour was gonna move price further up, then once that bar closes on the 9 o'clock bar, you should not see price coming down to the lows of the 8 o'clock bar. You see price coming down to the lows, you got to believe that something is not right here, and you just have to just be sharper with your trading. And you have to say, I know that this showed buying on the 8 o'clock bar, and I know that this looks like the open held, and I want to trade long because I think we're going back up this way. Then you're gonna, as you see, if you say, well, I'm gonna trade if it comes back to the open again, it shouldn't be that. It said no, it should not come back to the open again. It should open and go up. And not only should it not come back to the open, it definitely should not come below the open, and should not come below the low of the 8. When you see that happening, then it's suggesting that this selling that happened on the 5 o'clock bar is still in place, and then look for another reference area, which is yesterday's low, and that's exactly where price came to. So it's not just mechanical in trading, Nazar. You can't just say, I'm going to use these tools, and if it's green, I'm going to buy, and if it's red, I'm going to sell, and if I get to yesterday's open or a reference point, I'm just going to use it blindly. No, it doesn't work like that, Nazar. What you have to do is you have to read the story together, and you got to say, you say, this is where I want to get in because this is a good price. And if this is a good price, it shouldn't be coming back to what would be an even better price. Like if I thought if it's good to buy here, then if this is obviously a lower price, then if that was a great price, then this should not like price should, like if I bought something for $20 and I thought that was a great price, I shouldn't then be able to buy it for $15 because obviously the $20 was not a good price. And that's that when you could start to think like that, Nazar, that's when uh, you're gonna become you're gonna be more into what's happening in the market, and be better positioned to one number one, reduce your risk, and two, uh, if you're reducing your risk, you're putting yourself in a better position to gain. This is a 42-minute video. I'm going to leave it at that, but I definitely will be watching this video back a few times. I think there was some good ideas in here, and I need to listen to them more and follow it and practice it.